Good morning, it's Jeffrey Cohen, President and Founder and Investment Advisor Representative for U.S. Advanced Computing Infrastructures, Inc., also known as Chicago Quantum. Today is Wednesday, March 15th. Market's been open about an hour and 15 minutes. We're going to talk a bit about where we're at. I mean, the market is down. Let's be clear. In fact, what surprised us this morning, so if you look at CoiFin, they have the S&P sector ETFs, and you can see utilities is up 0.1%, but energy is down over 4%. Financials is down 3.3%. Materials and industrials are down around 3%. The market is down. Small cap is doing much worse than large cap, and it's really hard to watch. It looks like it tried to recover a little bit in the morning already, but it actually just bounced lower. And so, question is, what's going on, right? What's happening in the market that would make it do this, and then what should you do about it? And we run a model, so what does your model say, Jeff? So, first thing I want to do is I want to show a spreadsheet form of what our model does. And so, this is the output of our uprun from last night, market close. Let's make sure you can see it. Yep, you can. And we'll make it a little bit bigger for you. So the big thing about this is, what are the top stocks? So the Chicago Quantum Net Score, when it's negative, means that the risk is less than the expected return on a normalized basis. So it would say that for P&M Resources, Berkshire Hathaway, you're in a good position there. By the way, those stocks haven't changed. Those stocks have been at the top of the list for a while, as have many of these others. Crestwood Equity Partners, Tower Semiconductors, Illinois Toolworks, some of the Canadian firms, Sun Life, BCE, Royal Bank of Canada. You've got Accenture, Pepsi, Coke, right? Big household names. Cintas, the cleaning people. Thomson Reuters. So Honeywell, and if you follow the show, you've heard this a couple times already. Johnson & Johnson, Mondelez, Marsh & McLennan. So those are insurance brokerage, heavy manufacturing, food, drugs, and not the COVID ones. Otis Worldwide Corp, so elevators. ADP, which is a business-to-business, very, very large, broad company there. And McDonald's, and then some more Canadians, right? Toronto, Dominion, Bank of Montreal. So, okay. Now, if we look at the very bottom, and we run a down list, but let's just kind of reverse our thinking, right? What are the worst stocks? Atlas Lithium, ComSovereign, Contrafect, Jaguar, Revelation, Baudex, Corbis, Biora. So you see a lot of therapeutics and biotech firms. I mean, that makes sense. This eHome Household Services was a meme stock we saw out of China, which I can't believe it's even still trading. Oh my God. It's like a blast of the past, right? And then you see companies like Hive Blockchain and SNDL. But what's interesting about these stocks, these high-risk stocks, is the market cap for these stocks. A 9 means that there's no market cap tracked by our data provider, which happens. In fact, last night it happened a lot. I'm not even sure it was their fault. We ran the model early. We wanted to get a big hefty start. And so anything that has a 9 just is not valid. That's our error code. So if it's equal to 9, let's do a black fill. There you go. So you don't have to see it. Don't bother, right? And if you look, these are small caps, and that's fine. That's what you'd expect to see at the bottom of the list, right? If we go back to the top of the list, I would expect to see large caps. If this is true, then it'll show you something here. Now, they're not all large cap. Let's be honest, right? So data format is currency, and I'd like 1,000 separator in there. Good. So you see some pretty big stocks here, right? 670 billion, 32 billion, 48 billion, 71 billion, 260, 130, 240, 160. So large cap stocks tend to be at the top of the list, but hey, a 1 billion market cap, a 4 billion, a 4 billion, a couple of small ones, 7.5 billion, 7.6, but in general, these are larger cap. So larger cap stocks are tending to act less aggressively in this market, and that's fine. So what else do we see? Well, expected returns to these stocks. So the expected return is a percentage. And I'm just going to keep it simple. 5%, 8%, 8%, 9%, 7%. If we look at the bottom, they're higher. More risk. 13%, 11%, 11%, 12%. So our model suggests that if you hold the worst stocks, you actually are expected to earn money. You're expected to make money. You're expected to make more money because they're higher risk, they have higher beta, they have more systematic risk. If the market were to go up, they go up. The problem is that risk right now, risk is the name of the game. And so our model suggests that, yeah, you could earn more taking risks, but I wouldn't put your life savings in there, right? I would have maybe a very, very, very small amount of your investments in these risky stocks, or even short them, and have the lion's share of your investments in the large cap, more safety stocks. That's what our model's telling you. So let's go through some more things. How about volume, Jeffrey? How'd the volume do? So I like to look at it this way. The average volume compared to last year, so fascinating. It's 1.3, or it's actually 1.31. So yesterday's market was really crazy and traded 31% more shares of these 3,403 stocks. It traded 31% more shares than on average for all of them. That's a lot of shares. I thought we had limited liquidity and people were hiding in the sidelines, but that's not the case. They're in there, they're trading, and these stocks are responding. One stock traded 42 times its daily average. Their stock's really trading aggressively, okay? You look at dividend yields, and you can look at betas. We can look at dividend yields, right? Hey, Jeffrey, what are the top dividend paying stocks out there? And what you're going to notice is they're weird names, like a mortgage REIT, American Financial Group, Storm and Ruger, Financial, Capital, Properties, REIT. So your real estate investment trust paid dividends last year when things were going well. But this year, real estate, let's click on it, not going so well. This is the real estate S&P 500 chart. So, you were paying dividends up here at 48 and even 43, and it looked good. Hey, look, 44, 45. So you pay dividends, you kind of, you roll. Let's say you paid a 7% dividend. Well, now, the stock, these stocks have hit 33, they're up to 36. The stock's down 20%. The dividend yield, looking backwards, is 20% higher. And the longer it stays down, the more the 52-week average is lower. So REITs are actually paying higher dividend yields if they earned as much money as they did last year. But do you think that's the case? And these capital corporations, financial corporations, investment corps, do you really think that they're going to earn just as much this year as they earned last year? Now, if the answer is yes, if you've got a crystal ball, hey, that's great. But if not, the question is, which of these REITs are going to hold their own? There's one, there's two, there's a Realty Capital, Net Lease, Maybe offshore partners, island capital, right? Can they maintain the cash flow to pay the dividends? So that's an interesting way to invest, and I'm all in if I had time and a group of analysts who could do this for me. It's a lot of work. Got to dig into the actual, what do they own? Like what apartment buildings and what houses and what commercial real estate and how are the tenants and the leases and all that. So I don't know. Seems for me personally that's a little complicated, but it could be done. So what else is interesting? We talked about dividends. We could look at price changes. So these are the differences in price. So let's look at descending. So these stocks are up. This stock is up 800 per. I mean, that's a big number. I gotta highlight this for you. It's a number. I wonder if I can do a percentage. Maybe I can. Yeah, here we go. This is perfect. And then you don't need a... There. So the stock is up 800%. Atlas Lithium. Corbis is up 600%, but that's because it did a 15-to-1 reverse split. In fact, it's down probably 75%, 60%. But you see other ones. Maritime Holdings, Therapeutics, Bio, ComSovereign. A lot of biotech. So Madrigal, I've seen that one. Muscle Maker. Biosciences. And then you have NGL Energy Partners. Now that, they do clean water for produced water for oil drilling. They're a master limited partnership. Maybe they did something right. They had a lot of assets. They had no earnings. And they were making terrible acquisitions. So they own a lot. They owe a lot of money. But maybe. So I'm going through this and I see it's a lot of weird. Cooper Standard, Neogenomics, Elf Beauty. I don't know. Do you think elves are beautiful? I mean, I've seen Lord of the Rings and I've seen The Hobbit, and I'm sure they got the pointy ears, but I'm not sure Elf Beauty is whatever, right? I don't know. This all seems like crap to me. I'm looking at this stuff. I didn't hear any of it. Cytosorbents Corp. Inter Parfums Inc. Acero Therapeutics. Tasakos Energy Navigation Limited. I mean, finally, I see something I recognize. Maxar Technologies. Maxar Technologies is up 55% versus the 253-day moving average. Okay, that makes sense. They're the ones that offer the satellites that now people are using, like, to talk about the war in Ukraine. I use Maxar and have used Maxar to track real estate opportunities in the South China Sea, especially those islands that China has dredged out of nowhere and put really large airport runways on. I think those are terrific, you know? And so I use Maxar, and I've actually published on some of the exciting real estate opportunities in the South China Sea, the Spratlys, the Paracel Islands, closer to China, and then, you know, getting a little closer to Taiwan and to Japan and the Philippines and Indonesia. It's amazing. In some of those Maxar Technology satellite pictures, you can get down to specific buildings. You could see the athletic fields and the training facilities on some of these Chinese vacation home islands. I think it's terrific. And actually, in one of my articles, I show you how they make the islands, because they have some of their equipment out, and you can actually watch them building new islands. I think it's terrific. So Maxar, love it. I've used them. Good firm. Love it. But you go back up here and United Insurance. You know what that reminds me of? In Chicago, we have United Insurance. It's the insurance for people that can't afford insurance. So you can call, and that day you have insurance when you get pulled over by the police officer. Oh, of course I have insurance. 1-800-UNITED Insurance. You know, oh yeah, here, see, on my phone right there it is. I have insurance. It's the cheapest insurance by law, but I got it. You know? So, all right, fine. So those are the kind of things you see. Now let's look at the model. So this keeps me from losing all my money trading in the markets, right? So first thing I want to show you. And I get frustrated with this market because the market doesn't behave exactly the way I'd like it to. And I was early. So I did all this work on bank stocks. I was short bank stocks. I had puts on bank stocks, but I was early. Then the crash happens, and actually the stocks that I was short or had puts on are down so dramatically that I'd probably be a millionaire right now if I had held those investments. But, options are expensive to hold. They lose their value very quickly. And short positions are expensive because you have to pay back the dividend, you have to pay back a fee to borrow, and you have to pay interest. So you have to be right pretty fast. And I was not. And so I made some money, but not a ton. And to be honest, it was a lot of work and a lot of sweating in the service of the shorts. So now the banks are down, and you all know the story, right? 2 banks failed. Now, Credit Suisse raised money from the Saudis, and they won't put any more money in, and whatever. I mean, I read Credit Suisse's 10K early on before anyone else was really talking about it, maybe when the stock was $6 a share. And what was it? Pelagos, they lent money to leveraged hedge funds who went under. And the credit management, the risk management that they had on those losses, I want to say they lost like $3 billion from one borrower. This is like prime brokerage stuff. This is not supposed to be that risky. And so I realized they were in trouble because they are still not sure how they're going to get any of that money back. And then they've been probably levered up on new clients and just regulatory issues, compliance issues, reporting issues, management quality issues. And sure, it's a good franchise. It's kind of like a Roman Empire, right? Was amazing. For centuries, the Roman Empire. The sun never set on the British Empire, but the Roman Empire. They built roads, right, and all that. But you know what? I don't know if this is right or not, but Caesar fiddling on the throne there, and next thing you know, fighting the Visigoths, they're fighting the Germans. They lose because they rotted from within. And my guess is that that's what happened to Credit Suisse. It rotted from within, which is terrible because what a brand. Credit Suisse First Boston, and then the First Boston was removed from the name. The First Boston brand and franchise alone is worth more than the entire market cap of the company. But it doesn't matter because if you buy the stock now, it could easily go to zero. So that's the kind of thing that's happening. Banks are failing. Banks have taken losses. And then the Fed, and let me show you something. This is what the Fed has done, and it really frustrates me. Because it's wrong. It's wrong what they've done. We'll just look at the 10-year U.S. Treasury bond yield. There are others we could look at, but we're going to look at the 10-year yield just because it is the least likely to be manipulated. It is simple. It is big, is well held. It's probably the bond like the $100 bill. It's like a standard, right? So if you look at 2018, the yield was around 3%, which meant mortgages are running around 6%. It's fine. And in 2019, the yields are dropping. 2020, the yields are dropping. And now your yield on the 10-year is under 1%. Then it goes up to 1.5%. Now this is when the Fed really started to tighten, right? So now we're worried about inflation. We're worried about money supply at 1.5%, 2%, 3%, 4%. And now it's come down. And so not much, it's 3.5%. But this kind of up and down, and this real dramatic movement caught a lot of banks unaware. So I'm not sure if you're aware of this because this is why we were short Cullen/Frost. Cullen/Frost bought a lot of 30-year bonds here in the, let's say, 0.5% to 2% range. For them, it made sense. They were borrowing money at zero, and they were getting 2. They had a 2% net interest margin. They could be on the golf course by noon. You don't even have to make any loans. You take in deposits and you throw them into treasuries. There's no risk. You can even buy insurance on the treasuries because it's almost zero price. Wrap it up. But what happened is when the price fell, because the yields went up in August. This was in August. I was starting to short them because at a 3% yield, you're taking a bath. They lost billions. Then the yield went to 4, and they lost tens of. I mean, I don't know if it was tens of billions, 2 billion, 3 billion. They lost billions and billions. Maybe it was $10 billion. One little crappy 50th largest bank in the U.S. was probably down $10 billion. I have a whole spreadsheet. I did the whole evaluation. But now it's interesting because then the yields go down and up and down and up and down. And so let's say they bought insurance. They finally converted from a fixed rate to a variable rate. They paid their dues. They covered their losses and all that. So they covered their losses at around 4%, and now it's at 3.5%. So now those bonds are worth more. But maybe they traded away this newfound upside because they went from fixed to variable. It's hard to be a banker right now. The Fed's doing this. Now, if you look at a different yield, you know me, I always look at the 13-week. And the reason I look at the 13-week, and we're going to go 5 years, is because the 13-week is short enough that I can imagine if I wanted to stash some money in a low-risk fund, I would just go to treasurydirect.gov, and I've shown this to you. Again, if you watch the videos. So you go to treasurydirect.gov. You log in, savings bonds. So the first thing you do is you get your 10 grand in for your Series I savings bonds so you can earn 7%. And then you look at auctions. And you look at, let's say, 20 most recent auctions. 13-week bills. You see Jeffrey. I don't know that this is what I want, but here it is, 13-week, 98.8, pays you 100 in 3 months. Holy cow, 1.2. That's like a 4.8. That's like 4.8. There's probably some compounding in there. All right, fine. You just earned 4.8% if you bought 2 days ago a 13-week bill. That's nice. 4.8%. I'll take it all day, right? All day. Love it. Now, if you're going to buy, futures, it's different. Futures, it's a larger value. It's a whole thing, right? But if you take a look, we talked about it with the 10-year. In 2018, the yields were up to like 2.3. So that's when I remember I had money in the bank. I was earning like 2%, 2.5%. I was pretty happy. And then it drops to 0 for a very long time, very close to 0. Now it's at 458 basis points. It's at 4.58%. And it was almost 5%. It was like 4.7 not long ago. This is crazy. I just want you to know this is a very high risk-free rate. And the Fed did this. It raised rates without really thinking about it. So, we run our model. The risk-free return in our model is 4.7%. I promise you I'd get back to what I do. The expected market return of this whole thing is 3.9%. And so if you invest in risky assets, diversified, like the S&P 500, you're going to earn about 4% more than your risk-free rate of 4.7. The CQNS power is low at 3.33. That means risk is not quite as important as return, but it's getting there. Our precision of our model is 10 to the 19th, 10 to the negative 19th. So it's a very, very good precision. You see all the different stocks. And then what's interesting, I'm going to look off screen and then I'm going to see what I can show you here. It's a lot of details. So I want to just... Yeah. 62 stocks. The best portfolio has 62 stocks. And again, like the last video, there's some big names there. Apple, Intel, Intuit, Johnson & Johnson, Tesla, UPS, big names, Microsoft, Merck, Facebook, McDonald's, ADP, Adobe, AppV, Chicago Mercantile Exchange, big names, Amazon, Ford, Lockheed Martin, Eli Lilly, Coke, Pepsi. So this is very interesting that our model is looking at 3,403 stocks. We took all the gloves off because I figured maybe there was something in there, right? Maybe some of the small caps, pretty exciting. They're not that exciting. These are large caps. These are names you heard of. BCE, Bell Canada Enterprises, Google. I forgot who MC is. I don't know if that's MasterCard or not. I think it's MasterCard. Big names. And so what this says is if you've got to go out and buy 62 stocks and manage them, even if you bought these 62 and held them for 20 trading days to get that edge over the S&P 500, it's a lot of work. Hewlett Packard, by the way. Love it. You'd be holding 2 shares of Google. And Google, the different classes of shares. That's interesting. I always find it interesting when it puts both of the Googles in there. So, and there's positive beta stocks, and there's negative beta. There's positive skew stocks. There's negative skew stocks. There's leptokurtic stocks. There's platykurtic stocks. There's negative beta stocks. At the end of the day, what this tells you, and a lot of negative beta stocks actually, is that there's a lot of anomalies in the market. Yesterday saw a lot of volume. Remember, 31% more volume. 131% of the average volume over the past year traded yesterday. And lots of movement. But for you to have safety, for you to have return and safety, it's 62 stocks. Now, on the other server, you might hear a little tiny sound of a server. What we're running is we're running our model, and then at the end we ran like a really, really deep genetic algorithm, and then we're trying to find something a little better. And it looks like I got a tiny bit better. Ran it hard. Ran it for about 7,500 seconds, compute seconds. And it's a lot of seconds. 65 stocks. 65 stocks. It's funny. And the edge, let me go back to it. The best portfolio was 62 stocks, 72. The current edge is still 72. Right? 0, 0, 0, 0, 0, 72. It still is. It's not even, doesn't even round differently. But this one has 65 stocks. Okay. Got it. So it's a bigger portfolio PACCAR's in this one. It's in the other one too. I'm trying to see Texas Instruments. Nope, that was there. I just added a few more. B. Riley's in there. Ruger's in there. Sherman Ruger. Yeah. Oh, Juniper. Nope, it's in there. All right. Well, a few stocks got added to make it a tiny bit better. But so, it's good enough. 62, 65 stocks. That's risk off. So, on March 2nd, I keep this tweet to remind myself. On March 2nd of this year, the best long portfolio had 13 stocks. 2 times the alpha. So on March 2nd, the model was risk on and the model looked attractive. So what was going on March 2nd? That's actually an interesting question. Today's markets, we're just going to look at the S&P 500 and we're going to try to isolate March 2nd. So March 2nd, March 2nd, you were here. So this would have been March 1st, listed March 2nd. So on March 1st, the S&P 500 was down 4.47%. It was down in a pretty smooth angle, and it said the market is risk on. And then very quickly afterwards, the market went risk off again, and the market really dropped. And the market's been risk off this whole time coming down. So it's interesting that we found like a local minima. Like the stocks kind of settled down, and the model said, you know what? Risk is down a little. It's fine. It's fine. We're doing okay here. And so that's where we're at. We were able to basically call maybe a tiny bit up, and we're able to call this leg down. But, you know, it's interesting. So if you bought the run every day, you would know every day what the model says the market's going to do. And it's been pretty accurate, actually. So, all right, so where we're at now, energy is still down almost 4%. Financials are still down almost 3%. Utilities are up more. That means interest rates are probably down. Are interest rates down? Yeah, I think they were. If we go back to the bond rates, you can see the 10-year Treasury is down 0.21 percentage points. It's at 3.43. It's down 21 basis points. For those who are in the trade, they realize that this is an enormous move. It's like a 3 standard deviation move. It is a tremendously crazy and insane move. 10-year treasuries don't move 0.21% from 3.64 to 3.43 in a morning, in 2 hours. They don't do that. They never do that. The 30-year treasury is down 13 basis points. The 5-year treasury is down 0.31% or 31 basis points. These are historic moves in bonds. So if you're a bank, it's great if you're holding bonds with fixed interest rate risk. But you just got your butt kicked for months while the banking crisis has hit for holding those bonds. And now making a ton of profit. But if you somehow got rid of that risk, now you're taking it both ways. It's awful. So, I'm sorry. So, it's so interesting that interest rates are collapsing, falling, dramatically falling. And it makes you wonder what's going on. So, we got a couple things maybe to track, maybe to talk about as we close the video. And I'm going to type them here. Number one is interest rates are falling in massive amounts. Interest rates are falling significantly, materially. No, it's aggressively. Large moves to make bonds more valuable and interest rates to fall. So that's one thing I see. The second thing I see is I see energy and industrials, what I'll call the hard side of the economy, are down. Recession fears? I don't know. Maybe. What else did we see when we were talking? If we go to CoiFin, financials are still falling. Of course they are. Financials are still falling, almost down 3%. That's rough. That's rough. I don't like that. And I was early. I'm so mad for being early. I don't like it. I don't like it. I don't like it any more than you would like it. I was right. My analysis was spot on. I was just early. So, all right. The US dollar is surprisingly stronger. So that's weird. Despite falling U.S. Treasury interest yields. It's weird. That just means the world is doing worse. The U.S. is a safe haven. Maybe. That's 30-year bonds. Up. Now, the S&P 500 is actually doing okay. So, I don't know if this number's right or not, right? But the S&P 500 trading at 3,900. I have another chart I like to look at for that. That's not a bad level. So this one says 3866. All right. This one says 3866, so it may not be at 3,900. This is where you got to use the data that you buy. Now, I have purchased data for markets, and I don't use it for my videos because I'm not sure compliance-wise I'm supposed to. But you look here, and we're at 3867. Yeah, 3867, that's right. And you can see the losers. Lots of them. But utility's doing okay. And the model says go to the stocks that are larger. It didn't say NVIDIA, by the way. Meta, down 0.4. Microsoft's up. Apple, Google, J&J, Lilly. So if you would have held those stocks, Pepsi, Coke, your portfolio is probably up today. Intel, Texas Instruments. Accenture's down a lot. Amazon's down. But this portfolio would be outperforming the S&P 500 right now. That's the point. The Chicago quantum net score would be most likely, and on an ad hoc basis, outperforming the S&P 500 today on this risk-off day. Just what it is. Now, the other thing is, if you bet against the dogs, how would you be doing? Dog stars, Hive, Borks, Biohaven, Contrafect. So let's look at ATLX. I have no idea. Atlas Lithium Corporation. All right, you'd be down 3%. So if you would have shorted the worst stock in the model, in fact, it's been the worst stock in the model for like a week now. Oh, look at that. You would have written it up. You would have picked up our model. You would have said, oh, I need to short it at about 18 bucks. Now you're at 14 bucks. That's pretty nice. Let's look at comms. This is one of them. I haven't done this before, so this is not me taking victory laps. Comms is down 2%. Comms has continued to fall. It's been at the bottom of the list for a little while now. You can see that down from like $3 to $1.80. $3.60 to $1.80. You'd have made 50% of your money. That's not bad in a week or two. So yeah, the dog shit stocks at the bottom are still dog crap stocks. In a risk off market, and when the market's falling, you want to be short the down stocks. Just get rid of them, or at least don't hold them. Don't do it. Don't do the crime if you can't pay the time. Don't do it. What else we got? Well, it's not bad. The S&P's only down 1.3%. This is part of why the market is risk off. It's my guess is that the S&P is going to recover today. And why not? Right? Rome is not burning. I mean, it sucks and all, but it's down, but it's probably going to recover. It's at least maybe revert to the mean a little bit, right? And so with risk coming down on the S&P, it doesn't look good. These charts look terrible, right? But with the S&P 500, you really could have more calm. It could still be going down. It could still be a bear market, but it could be going down in a more orderly fashion. So let's take a look if I have anything else to share. So there have been a few other things that kind of stood out. Number 6, Bitcoin is up. Bitcoin's at 25,000. 24/7. And it was recently at 20,000. So it is up 25%. I don't know why. Markets are crashing, banks are crashing, money is being dissolved, but yet Bitcoin was in this kind of tremendous decline, and then boom, popped right back up. I have no idea. I honestly am not a Bitcoin expert, but I'm always amazed how Bitcoin seems to be a little counter-cyclical. We're going to take a look at some industries, some stuff. So these are the stocks that I call holdings. They're not my holdings, but they're stocks that I might hold if I was going after, crap stocks, fallen angels, and stocks that are like deep value names, right? So there's your Credit Suisse. There's Alcoa, Cleveland Cliffs, Summit Midstream Partners, Freeport McMoran. It's heading into beautiful territory. Love these stocks. DXC, I don't really love. FATH is a digital manufacturing firm. That's one of those meme stocks. Rio Tinto, Citibank is starting to, if Citibank hits like $1.25, I'm all in. Oh wait, it's at 45 still. Yeah, we got a ways to go. Nah, it's going to keep going. Qubits, D-Wave is down again. I still owe the world some due diligence on that one, and I promise I'm going to do it. I actually had an epiphany last night. I was thinking about how I run on the D-Wave, and I have a whole new approach. I wish I had a research team. I think I know how to make the D-Wave make us some money, but that's fine. Vale, Petróleo de Brasileiro, Petrobras, Petróleo Brasileiro. I love the Brazilian people, by the way. I had a really good time when I would go work there. Lumen continues to fall. So fascinating. Q-rate, I told someone don't buy it at 2. I begged them, don't buy it at 2. At 1, maybe. I haven't tuned in any of their shows yet, but we'll see. ATI Physical Therapy, Hormel Foods, Lyft, Yellow, which is Yellow Roadway and Consolidated Freight. There's lots of stocks in here. There's lots of interesting things. And, I track a lot of stuff today. So, Fathom Digital Manufacturing is a small company in Wisconsin with 700 employees. And honestly, I like it. Plastic and metal additive manufacturing. So, etchings, castings, fabrication, CNC machining, printing, metal printing. So I should actually be studying them. But what's interesting is their last 10Q is in November, December, January, February, March. Where's the 10Q? Right? So I'm not in until they fix whatever it is they're supposed to fix. I don't even know what's broken. But all I know is it's going to require some homework. And I don't know that I have time for a lot of homework. There's so many things I'm supposed to be doing right now. Do you know I'm updating the services on my website? It takes forever. Oh, it's so frustrating. ATI Physical Therapy. I love ATI Physical Therapy. This is a business that should scale. By the way, they pay their executives a lot of money. Probably pretty stupid. ATI Physical Therapy are like strip mall locations where they help people to treat injuries. Hand therapy, aquatic therapy, functional capacity assessments, wellness programs. They have the, right by our workout facility, there's an Athletico, which is different than ATI, but Athletico, it's a tiny strip mall store, maybe 10 pieces of heavy equipment, a table or two, stretching equipment, those big balls, those half balls, all that stuff. And they work with you to get better. I used physical therapy when I had knee surgery. It's nice. It's good. I like it. And so it's a tough business, though, because they've had to transform their business in order to make money. So their last earnings is they haven't even reported the end of the year. But the problem is that the profit is down. It's a negative profit. So this kind of company has to make money or else there's no reason to be in business. There's no reason to own a stock if they don't make money. It's a services business. It's like a massage therapy store, right? If you're going to go to a massage therapist and pay your whatever $50 for a massage, $100, $20, $500, whatever it is, you're going to pay for a massage, you kind of hope that the massage store is making a profit at the end of the month. Or else either raise your prices or shut the door. All right, steel and miners. This is a global list. A lot of global names lost money today. A lot of global names. Tata, BHP. But then you start looking at like Steel Dynamics down 11%. Nucor down 6.5%. Freeport McMoran down 6%. Cleveland Cliffs down 8%. U.S. Steel down more than 8%. These are big declines. Why is the industry looking so bad? And Rio Tinto sees robust short-term outlook for copper. Well, if that's the case, Freeport McMoran, who's I think the world's largest copper miner, wouldn't be declining. Now, what's interesting is you look at it over the year, and it's actually still up. This was a $25 to $28 stock. It's just coming back down. And so, yeah, maybe that's the story, right? Computer chips, telco, B2B. How we doing? It's a mixed bag without a lot of direction. I do like Hewlett-Packard Enterprises. I've always liked Hewlett Packard Enterprises, and at $13.90, it's getting close to that $12 range where I owned it before. I bought it and I sold it on the way up. Retail stocks. My guess is this is going to be a shit sandwich here on the retail side. Not so much. It's mixed. It's interesting, right? I thought the market had crashed today, but we have these proprietary indices we created. Trucking and transport. How are we doing on trucking and transport? We're doing great. It's more green than red. It's mixed. It's 50-50, but it's not bad. Yellow's up. Coal. I think coal is a difficult business right now in the United States. Look at that. Solid green for the most part. BTU, which is really a large one. Peabody Energy, I think, is the largest heating coal producer. And you can see it's down. Arch is down. The other side, so it's mixed. Coal's mixed. Highest beta. Now this is interesting because it's not a current list. It's a little bit older. But your high beta stocks are down. Which makes sense. A lot of small, like Bitcoin miners and weird Mara, Square, Fletch, Farfetched. Yeah. Was that Open? Oh, Open Door Tech, I don't know. But Coinbase has actually been holding its own. Upstart, holding its own, surprisingly so. So, yeah, it's hard to know. Where are we at, right? Quantum companies. This is my area of excitement here. Qubits, 61.92. It's interesting, it's recovering a little bit. Arcit up over $1. Rigetti has dropped to 58 cents. That's not helpful. I have a story, though, about Rigetti where maybe I made a mistake and I trusted the CEO and he did something very mean. Potentially unethical. Definitely mean, and stock's down from $10 to 58 cents, so I get it. Maybe a lack of confidence. Oh, look at that. Deutsche Bank is down to $10. ING, BNP Paribas. You kind of have to take a deep breath and try not to vomit when you start to see stuff like this. It makes me very nauseous, just so you know. Societe Generale, down 13%. BNP Paribas, ING, Deutsche Bank, UBS, Barclays, HSBC. These are very tough stories. I know, Pumpkin. I will try not to vomit. I'm so sorry, people. I'm sick to my stomach. When I see this, it just makes me ill. These are large, established banks in Europe. And the market caps are tiny, relatively speaking. I'm so sorry. I'm so sorry, people. This is really going to hurt everybody. So when the banks fall, we all fall. I know Diana was like, I know you're right about the banks. I don't want you to be right. I used to talk to her every day at dinner about the banks. They're going to fall. They're going to crash. It's going to be terrible. And she understood the logic of it. She said, I just don't want it to happen. Jeffrey, I don't want to hear about it anymore. This is interesting. Boeing made a huge, massive recovery since October. Could come back down. I don't know. Not feeling anything right now. Any news on crypto? You can see some of them are down, although Bitcoin's been pretty solid. The euro to US dollar is down to 105.25. Look at that drop. Look at that massive drop. because of the European banks. Come on, this changes the... So, I'm very excited here. Number 7. European weakness in their banking sector weakens the euro to US dollar exchange rate. It's interesting. So I would say mixed overall stock results with significant weakness in large industrial, energy, financial, I won't say tech, although tech is down. And to a lesser extent, technology stocks. This is when you get your shopping list dusted off. All right, I want to thank you for watching. It's been about an hour. Oh. Okay. Hi, Connor. Fed rates. Give me a minute on that one. And D-Wave Systems, video and due diligence. So, let's go to D-Wave first. So I'm going to share a lot of inside baseball. Hey, thanks for the question. We'll start with D-Wave. So, if we go back in time on the D-Wave to August of last year, when the market returns were higher, we ran the D-Wave and we ran 118 stocks. But in fact, we ended up running 80 stocks because 80 stocks fit on the D-Wave. We built our matrices. And what we do is we build a different matrix for each size portfolio. So if it's 10 stocks, we have to divide it out by 10% and do the math to make sure it works. So you could have 10 stocks chosen each. 12 stocks, and all the way to 80 stocks, because you might pick 80. And then every time we run through the model, you can see we have a match where we say, okay, run a 5-stock model. Here are 5-stock matches, but many times you don't have a match. And so those results get lost. So in this case, maybe we ran it 200 times, and maybe we picked up 2. So 2 out of 200. This one we ran 200 times, actually did a lot better, right? We ended up with a whole bunch. 14 stocks. We got a lot of 14-stock solutions. And by the end, we look at what we resulted in, and the best portfolio had these stocks in it. And you're going to see some of the names are going to be familiar. Silvergate, Melly, KLAC, KLA Corp, Apple, CEQP, Preferred, Coinbase, Amazon, Honeywell. So it picked good stocks. It did okay. But the best pick was Alto, J&J, and Silvergate, which would have given you triple the edge over the S&P 500. You got a similar result here. So in running the genetic algorithm in 11 seconds, we were able to do 3 times better than the D-Wave. And that was the issue, right? So now we got to run the D-Wave. So what we did is we actually recently ran the D-Wave. This was last month. Yeah, Lightspeed is one of those we're looking to maybe short. It's a dog shit stock. So you did not hear it here first. All right, so what do we have? So I ran the D-Wave 3 times, like in 113 milliseconds, and got a minute left for this month. And it didn't give us much. And so what happens is I'm going through and I'm rethinking, do I really need to have 80 different matrices and 80 sized portfolios? So the key is you can't have a one size stock portfolio, because that would mean one stock, no covariances. You could have a 2 stock portfolio, and that would mean you have covariance. What I don't know is the difference between, let's say, 2 and 3. And so, I mean, when I look at these, big matrix for 2, big matrix for 3, the numbers are different, and so maybe I can. So I'm thinking I'm going to have to come up with an entirely new way to build our matrices, to scale our matrix, and to run. So for D-Wave, the issue is almost like it's mine, because let me see how to describe it. This is the output on the D-Wave. This is what the actual D-Wave computer looks like when we run it. So you see, you got all these qubits here. That whole area is available for your solution. But our solution only maps onto the middle part. We're going to look at it a couple different ways. It's elegant when you look at it, right? That the winning solution pulls together a group of stocks that are mapped together. So it's hard for a stock to be picked if it has to connect a long distance along the plane. So with the D-Wave, you have to be thoughtful of the physical positioning of the stocks on the D-Wave. And that's done through mapping. I'm not great at mapping. This is what happens when you have the top of the matrix. You know, you have like there's the triangular top and the bottom. And you can see that with 80, this is actually 120 stocks we ran. I can actually look at that. Yeah, we have 118 stocks. We're at maximum. So when you load 118 stocks on the D-Wave, you're pretty busy. You're using a lot of the room on the D-Wave. 118 stocks. Now, here's all the info about the solver. Let's take a look here. A good answer is a negative answer. So if we look here, you can see a good answer is negative. It's basically negative 0, but it's negative 4.5 times 10 to the negative 4. These answers are positive, between 0 and 5. So they're no good, Nick. They're not good answers. So it's a nice, elegant solution where your stocks it's picking are very close together. And all these warnings, chain length warnings, means Let's pull it up. So what it means is that every single portfolio, it's at a risk. Basically, you can't connect 118 stocks to each other. You see the yellow over there? You can't connect 118 stocks without having long chain lengths. And the issue with a quantum computer is that the coherence, or the time that the problem stays set up, this beautiful, elegant picture, it breaks. It breaks. And so I just want you to think about it. Like qubits break. Not that they break like I have to call the maintenance guy, but they lose their coherence. And so if you lose a variable, if you lose a stock, if you lose a connection between two stocks, if you lose a very important stock or an important qubit early in the process, then you lose the whole possibility of having that stock in the solution. So you need to make it simple. You need to run it maybe over and over again. You need to randomize the mapping and hope and pray that it works. So what we do, we have two ways of running it. We can run it, get a good mapping, and save the mapping, or we run it random every single time, and then at least we get some diversity in our results. So the answer on the D-Wave is, it's really complicated. And so last night, I came up with some ideas on how to run it on the D-Wave. I don't even know that I should be showing you these notes, but I'm going to show them to you because I just want you to see it. So my thoughts on the I can't even make it bigger. Can I make this bigger? Yeah, I can. Here we go. So I'm thinking maybe we have to change the structure of the matrices. Maybe a two-stock matrix, maybe an n-stock matrix, where n is a reasonably sized result. So if the Chicago Quantum Net Score best answer is 65 stocks, can I use a 65 stock matrix? Just as an example. You know, that other day, it was a 13 stock solution. So maybe that's it. And then you had to run the D-Wave, but not too often because it's expensive. But it's not that expensive. It's expensive. You got to pay for it. I already own all my servers. I don't have to pay Amazon. I can run this thing all day. What I told you, I ran it like 10,000 seconds. 10,000 compute seconds. Yeah, that would cost me my life savings on D-Wave. I get 1 second a month. So, and then my thought is just like I showed you back in August, every time I get a solution that matches, great. Two-stock solution, I get a two-stock answer, it automatically calculates the energy. All right, it's negative, it's great, keep it, I love it, good stock pick, yay. But what about all these others? Here's a 17 stock solution. Here's a 14 stock solution. Here's a 17 stock solution. There are hundreds of solutions that are left behind. My thought is, test them all classically. Let the D-Wave pick the best solutions. Let's be right. Like, this is a great solution. 13 stocks, this is probably the one we used. Beautiful solution. Elegant. Looks great. Yep. But the one right next to it with 11 stocks or 14 stocks might be just as good or better. So I think that's what I have to do. And then there's other tuning that you can do. So what happens is, this is going to get a little complicated, right? So that when you're running the D-Wave, you got to be thinking about all this stuff. You see the matrix here? We can do a linear transformation of the matrix. I call it lift and shift, just because I'm not technical. So what it means is that I can apply a scaling factor. I can apply an adjustment to the values that keeps the integrity of the matrix, but, love this, I can get it to find larger or smaller stock portfolios. Love it. Love it. I want to do that. And so once I run it once, I can lift and shift. And then run it a second time. Check the answers. Lift and shift. Run it a third time. Once I like it, then I really run it. And so I don't have to do that in a server. I can just automatically do all that stuff. But here, maybe I can get it to the point where I get a really good answer. Now, the benefit of this is the server takes an hour, 2 hours to run the solvers. At least an hour. I've never had to run less than an hour with all my comprehensive repetitive runs and recursive runs and then runs on top of the runs to take all the best solutions and run them. So the D-Wave takes 115 milliseconds. I get my answer in 10 seconds. I could load my data in an hour and then have my answer in 10 seconds. Wrap it up. Maybe I can load the data faster, make it even easier. This whole thing could be wrapped up fast. So the answer with D-Wave is, if I can figure out how to use the qubits, I win. Okay. Got it. So now, the Fed. When I think, so you're welcome, and I'm glad I got the question. Thank you. So when I think about the Federal Reserve and I think about inflation, the first thing I think about is CPI. And the producer price index just now, food is still up almost 10%. And in fact, housing is up. And I know Chairman Powell said the whole thing with housing and it's coming down and we're all going to be great. And maybe he's right. And the producer price index came out. And producer price index came out today. And it said that producer prices fell in February. They fell a little. It was nice. What went up, there were certain things that went up, but most of the drop was because of chicken eggs, fresh and dry vegetables, diesel fuel, home heating oil, and basic organic materials. But metals are getting much more expensive. Iron and steel scrap went up almost 11%. So, producer prices went down, which means probably March, April, you're going to see some benefit. All right, so where does that leave the Fed? I mean, I have a tongue-in-cheek answer, but that's not what I want to give you. What I want to do is stick to the real script here. So the Fed has been doing quantitative tightening, and we've got the assets that the Fed's holding down. It's less than 10% from the peak, but at least they've been tightening. That's helpful. So I think they're still going to buy back assets. So it's interesting because, let me show you something. The same chart I showed you before maybe will answer the question. So I have an answer, but I'm trying to give you a sense of where my head's at with this, the data. So if I look at Treasury bond rates and I look at the 13-week Treasury bill at 4.5%, we're at the bottom end of the Fed funds rate, basically. The bottom end, 4.5%. If I look at the 1 month, we're at 4%. So the market's kind of spoken. And the market said, rates are too high. I'm willing, as a market participant, to put so much money in the bank and take it off the table that I'm driving down the yield. The supply and demand is, I want my money safe. And so if the Fed wants to raise interest rates, they're going to have to take a really strong effort to do it. Because right now the market rate is lower than the policy rate. And so for them to raise the policy rate, let's say to 5%, how are you going to do it? You're 4%. Your 13-week is at 4.5%. So I think, and you got a banking crisis. Pretty big one. By the way, we're going to pull up a bubble chart of the banks. Just because I think it's important. I'll do sector. I'll do financial sector. You've got some that are up, but you have a lot that are down. And the majority of these are down, looks like around 3% today. And if you look at it, it's been down, if we were to look over the week or over the month. So if we were to do a map, S&P 500 for a month, you can see the large banks are down anywhere from 10 to 20%. So what helps the banks? Well, I don't know what helps the banks. So coming back to my answer. I don't know what the Fed will do. I think they should raise rates further, but that is useless without the New York Fed taking aggressive action to raise market rates. There is a huge flight to quality and safety. Yeah. Maybe irrelevant this month. That's where I think I'm at. What do you think? What do you think, Connor? See where Corbis is at. Huge flight to safety. That's what I see. Oh, the other thing on D-Wave, just to go back to it, there's some uncertainty on some things. So D-Wave, I have the SEC website up here. So they, it's interesting because they said, look, we have a new contract with our fab. New contract with Cypress Semiconductor, but they don't tell you what it is. So, okay. So at least they still have a contract, but there's no content. And so you have to go back to November for a quarterly. And in November in the quarterly, oh, and remember that I am long. Oh, like you're saying, I don't know. They hold. You think they're going to hold? there is a large factor at work here. There is the U.S. Congress and the President. They are stimulating the economy still. And plan to do it for the next 2 years aggressively. Let me show you what I mean. So if you do a search on President budget, you go to the White House, President's budget, and you click read the budget. By the way, I made a video about this. That's why it's easy for me to do it. And you scroll down to summary tables. There's something very, very important here. So the way you read the budget is you look at outlays and you look at receipts. Outlays, spending. Receipts is what they take in. And so the federal government is going to spend, already spent basically in 2022, 6.3. They took in 4.9, so they had a deficit of 1.4. They're planning on boosting outlays to some extent, a little bit. 100 billion, 200 billion, 200 billion, 300 billion, right? So that's cool. What did I say? 100, 200, 200, 300. But they've decided that in 2023 and 2024 that they would lower taxes. You never hear Biden say he's lowering taxes, but he's looking at lowering taxes $250 million. And then only raise them by $70 million, and then $180 million, and then billion, and then $400 billion, and then $350 billion, and then $250 billion, and then $250 billion. So he's raising outlays by 100, 200, 300, but he's actually lowering taxes by 250, and then he's raising it by 70, and then 180, and then 400. And so he's stimulating in the billions of dollars. And so, oh, and then there's the whole thing with the banks and the bailout. That's got to be worth at least a couple $100 billion. So the Fed doing nothing still means the U.S. federal government is stimulating at least $350 billion into 2023, and it looks like another $300 billion into 2024 and the next presidential election. So the Fed's got to take action. The Fed knows this is happening. The Fed is the one that's supposed to take the fall. And so I guess if I'm a betting man, the Fed may not raise. The Fed may not raise. So I guess if I had to make the call, I call zero hike. All right. It's my best call from where we're at. It's too messy, but they have to hike. They are building up debt. Monetary slack in the system again. And that's the issue. You know, I could take this back to something though, right? So the Fed waiting is bullish for stocks. I mean, you know that. I know that, right? And so when we look at interest rates, and we looked at them, the 1 month is under 4% now. Look at that thing just collapse. Look at it collapse. All right, thanks. You're welcome. So with the 1 month treasury collapsing 35 basis points, so that's an enormous move. That's the kind of move that destroys markets, destroys worlds, right? That's a big move. That's a crazy big move. And my guess is if we look at the 1 year, we're going to see a similarly large move. Down 42 basis points. So the market, it's a flight to quality. It's a decline in rates. It's awful. So, all right. By the way, just in case you don't know, I own Corbis, long-term holder. It's hanging tough at $3. Who knows what's going to happen? But it's nice to see it didn't collapse today with all the other stocks. And yeah, we're always kind of keeping track on this one. And that's it. Hey, thanks for watching. I appreciate it. If you like the video, please hit the subscribe button. It helps me. I don't get paid to make the videos. I'm trying to spread the word. And appreciate it. All right, take care. Bye-bye now. Good luck.